Welcome back to my YouTube channel Smart Paisa with Saraswati. Today I am going to give you one of the most valuable book summaries you will ever hear. The Little Book of Common Sense Investing. Most people think investing is complicated. They run behind hot stocks, listen to tips, trust TV experts, and hope to become rich one day. But what if I tell you the simplest way is actually the most powerful way? The entire truth is hidden inside one little book, The Little Book of Common Sense Investing by John C. Bogle, the founder of Vanguard. Today I will give you a complete book summary so clear that you never need to read this book. Let's start building wealth. The common sense way. Section 1. The big idea of the book. This book revolves around one powerful truth. Don't try to beat the market, just buy the whole market. John Bogle says stock picking is risky. Timing the market is impossible. Fund managers charge high fees. Most people lose money because they try too hard. But the stock market as a whole always grows in the long run. So instead of chasing winners, just invest in all the companies together using index funds. Section 2. Why active investing fails. Let's understand why people never beat the market. Experts are often wrong. Fund managers try to beat the market but usually fails. Why? Because markets move unpredictably. Higher fees eat your returns. If a fund managers even 1% fee, if a fund manager charges even 1% fee over decades, you lose lakhs or crores. Emotional investing kills returns. People buy when markets are high, panic sales when markets are low. The book says clearly in the short run, the market is a casino. In the long run, it is a mission for growing wealth. Section 3. What is an index fund? John Bogle introduced the world to the first index fund. What is it? An index fund simply copies the market. Example Nifty 50 index fund invests in the top 50 Indian companies. S&P 500 index fund invests in top 500 US companies. Why is it powerful? Because no fund manager, no stock picking, no timing, no emotion, very low fees, It's automatic wealth creation. Section 4, Magic of Compounding. Bogle says the truth miracle is compounding. If you invest 10,000 every month in a Nifty 50 index fund, after 20 years at 12% CAGR, it may grow to 1 crore plus. Why? Because your money earns money, and that money earns more money. Time is your friend, impulse is your enemy. Section 5, The Cost Matters Hypothesis. One of the core ideas in the book is the lower your costs, the higher your returns. Example, Fund A 2% annual fee it collects. Fund B 0.2% annual fee, none other than index fund. Invest 5 lakhs for 30 years at 12% returns. Fund A 43 lakhs it gives. Fund B 66 lakhs it gives. You lose 23 lakhs just because of fee. This is why John Bogle says in investing you get what you don't pay for. Section 6, Market Noise versus Real Returns. Markets move daily because of noise, news, politics, emotions, trends, global events. But long term returns come from corporate profits, dividends, growth, innovations. Ignore the noise, focus on fundamentals. Section 7, Investor versus investment returns. Bogle explains a shocking concept. Investment return is equals to what the market gives. Investor returns is equals to what you actually get. Most investors get less because they buy high, sell low, switch funds, chase trending stocks, react emotionally. An index fund stops this behavior. It forces discipline. Section 8, Simple Rules for Successful Investing. Here are the exact simple rules from the book. Rule 1, Invest early. The earlier you start, the richer you become. Rule 2, Invest regularly. SIP is your superpower. Invest for the long term, minimum 10 years, ideally 20 plus years. Rule 4, Keep costs low. Choose index funds or ETFs. Rule 5, Avoid speculations. Crypto, penny stocks, hot tips, stay away. Rule 6, Stay the course. Don't stop investing during market crashes. Those who continue become billionaires. Section 9, How index funds beat most investors. John Bogle gives real world data. Index funds win because they don't churn the portfolio, they don't charge high fees, don't try to time the market, don't make emotional decisions. Over 10 to 20 years, an index investor usually beats 90% of mutual fund managers, 95% of retail investors, 100% of gamblers. This is why the world's greatest investor, Warren Buffett, Charlie Munger, also recommend index funds. Section 10, Risk Management, the simple way. The This book doesn't say index funds are risk free. It says they are the least risky way to invest in the stock market because you invest in the many companies, even even if a few fail, the market survives. Diversification protects you. Long term trend is upward. Section 11, Practical steps to start. If you want to follow the book exactly, here's what to do. Choose a broad index, India Nifty 50, Nifty Next 50, US S&P 500. Step 2, start a SIP, even 500 or 1000 is fine. Hold for long term, minimum 10 to 20 years. Don't check your portfolio daily. Check only once every 3 to 6 months. Step 5, keep fees low. Use index mutual funds or ETFs. That's it. Simple, powerful, life changing. Section 12, Key quotes from the book. Here are the best quotes. Stay the course. Time is your friend. Impulse is your enemy. Don't look for the needle in the haystack. Buy the haystack. The miracle of compounding is real. The stock market is a gained distraction from business results. The Little Book of Common Sense teaches us one powerful truth: wealth is built not by complexity but by consistency. If you follow the simple index fund approach, you won't become rich overnight, but you will become wealthy over time. If you want summaries of more finance books, comment below.